Source material speaking. One creator, one handle, two platforms. Same name on both. If someone else is running this format, they're running a copy. Drop source in the comments if you're watching with real attention. I don't sell anything. I've never sold anything. Protect yourself. Now let's get into it. Iranian state broadcaster has confirmed the deaths of Supreme Leader Ali Khamenei and former President Mahmoud Ahmadinejad following coordinated U.S.-Israeli air operations. Per state media, the Supreme Leader has reached martyrdom. Two of the Islamic Republic's most powerful command figures gone, simultaneously, in coordinated strikes. The assumption was that their deaths might pull the conflict back from the edge. The assumption was wrong. What followed was a retaliatory launch at a scale that removed any ceiling from this conflict. Iran's IRGC has deployed 165 ballistic missiles, 2 cruise missiles, and 541 drones since yesterday's operations began. Air defense intercepted 152 of those inbound ballistic missiles. 56 drones destroyed in the air, but 35 drones broke through. 21 hit civilian targets in the UAE this morning alone. 3 people confirmed dead, 58 injured, multiple nationalities, moderate structural damage to civilian homes and infrastructure across the Emirates. The UAE is not observing a regional conflict from a distance. The UAE is physically inside it. Then came the calculation-changing moment. Iran's Revolutionary Guard Corps announced targeting the USS Abraham Lincoln Carrier Strike Group with 4 ballistic missiles. The last time an adversary launched against a U.S. carrier was the USS Stark in 1987, and that was an Iraqi exocet, not a deliberate state launch. This is different. Iran's stated position. No red lines remain. Responses will continue. Here's where physical markets disconnected completely from the Western financial narrative, and most analysts missed it entirely. China's Desheng Bank issued an internal notice this weekend. If price movements create a significant enough deviation to deplete accumulated yuan gold liquidity, trading will be suspended pending stabilization. Read that carefully. A major Chinese financial institution is formally acknowledging that the pressure on its gold market is real enough to require an emergency circuit breaker. This isn't hedging language. This is institutional acknowledgement of structural stress. The dark market gave you the number. PXG, tokenized physical gold, redeemable for allocated vault metal, running on blockchain infrastructure that never closes, reached $5,600 per ounce during Saturday's session, currently stabilizing near $5,400. That's a $122 premium over Friday's official COMEX close of 5,278 airs. Traditional markets close for the weekend. Physical-backed instruments don't. The price discovery happened without COMEX's participation. Silver's weekend signal was sharper. A Chinese commodities trading advisor confirmed that physical silver buyback premiums between small distributors in Shenzhen jumped approximately $20 per troy ounce in a single session. Shenzhen buyback prices are now quoted north of $120 per ounce. Small Chinese distributors have largely stopped selling, anticipating that physical supply will not return at anywhere near current Western paper pricing. Cross-platform weekend silver data. IG weekend spot near $100, Kinesis silver at $100, Hyperliquid at 96 sound, Shanghai spot at $105, Shanghai futures at $108, Western paper Friday close $93. That's a $7 premium on IG, $12 premium on Shanghai spot, $15 on Shanghai futures, and Shenzhen physical markets at $120, a $27 premium over Western paper. One more layer most channels missed, COMEX registered silver inventories. The ounces actually available for contracted physical delivery have been declining on a structural basis for months. When physical buyers in Shenzhen are paying $27 above COMEX and refusing to sell back, the registered inventory floor matters more than it ever did on a calm Friday afternoon. 3 assets matter when the system gets stress tested like this. Gold, the monetary reset hedge, the asset central banks cannot manufacture through a policy meeting. Silver, the industrial shortage play. No synthetic substitute exists for its role in photovoltaic cells, EV battery systems, or advanced military electronics. Oil, energy cannot be printed into existence by any treasury. Everything else, equities, narratives, unsecured fiat, trades on sentiment and storytelling. These 3 trade on physical necessity. Right now, all 3 are moving in the same direction simultaneously. The Strait of Hormuz is not closing because of a naval blockade. It's closing because of something more surgical and harder to reverse, the Lloyd's of London war risk insurance market. War risk premiums on commercial shipping are the invisible mechanism that actually controls whether global energy moves. 2 vessels are confirmed attacked near the strait's entrance. The Palau-flagged oil and chemical tanker Skylight struck near Kasab with 4 crew injured and 20 evacuated, and the MKD Vion, now on fire in the same approach corridor. Two burning ships at the entrance to a choke point that carries 20% of the world's seaborne oil is not a navigational inconvenience. It is an actuarial event. War risk insurance premiums on a $100 million tanker transiting the strait jumped from approximately $250,000 to $375,000 per voyage in a single session, a 50% surge. When Lloyd's syndicates stop quoting or reprice that aggressively, shipping companies don't evaluate the risk independently, they anchor. Over 150 tankers are currently holding position in open Gulf waters, engines idling, cargo aboard, going nowhere. Maersk has officially suspended all Strait of Hormuz transits. Oil and LNG carriers are motionless off the coasts of Kuwait, Qatar, and the UAE. Brent crude trading 8 to 10% higher, holding near $80 per barrel. Weekend gains are not eroding. This is a supply shock, violent, structural, not temporary. Approximately 20 million barrels per day frozen. 100% of Qatar's globally dominant LNG export flow simultaneously blocked. Context: the 1973 Arab oil embargo disrupted approximately 5 million barrels per day. Current markets are absorbing a threat to 4 times that volume. Iran's operational doctrine extends well past the strait itself, and this is the part most financial analysis hasn't processed. They struck Duqm in Oman. Duqm was engineered from the ground up specifically as a Hormuz independent export facility. The entire capital rationale for its construction was supply chain resilience against exactly this kind of closure. Iran just invalidated that infrastructure's core value proposition in a single strike. They hit Jebel Ali in Dubai, the port terminal processing approximately 60% of total UAE imports. This is not a symbolic target. Crippled Jebel Ali and Dubai's non-oil economic engine stalls. They attacked Mina Salman in Bahrain, home to the U.S. Fifth Fleet. Military and commercial infrastructure sharing one geography now share one risk exposure. They struck Haifa in Israel, targeting the eastern Mediterranean end of the energy import chain. The operational logic is pure asymmetric doctrine. Carrier strike groups are optimized to protect airspace and neutralize naval threats. They are not designed to defend distributed port logistics networks from coordinated low-altitude drone saturation. Every terminal, every crane, every tank farm is a soft target. Iran isn't trying to sink ships. Iran is systematically disabling the infrastructure that processes those ships' cargo after arrival. The economic damage is the same. The military countermeasure doesn't exist. The nations absorbing maximum displacement from Hormuz disruption represent 69 to 75% of all crude flows through the strait. Japan pulls 75% of its total oil imports through that waterway and is close to 100% import dependent overall. Japanese tankers are already recording course reversals. South Korea sources 60% of crude through the strait. India draws approximately 50% of its crude imports from Gulf producers, roughly 2.6 million barrels per day, plus 60% of natural gas and LNG supply. Fuel prices spike. The rupee compresses under energy inflation pressure. GDP growth forecasts require immediate downward revision. China is the single largest absolute volume buyer at 55 to 60% of crude imports through the strait. Russian pipeline infrastructure provides partial insulation. Beijing still absorbs massive price pain, just structurally better positioned than Tokyo, Seoul, or New Delhi. Intellectual honesty requires the counter scenario stated plainly. Weekend premiums in thin liquidity markets, crypto spot, tokenized metals, systematically overstate the actual convergence level. Futures gap at open, then fill. Back-channel diplomacy could activate within 48 hours. Hormuz war risk repricing could compress if carrier group repositioning changes the actuarial calculus for Lloyd's syndicates. Physical silver premiums in Shenzhen could compress sharply if COMEX opens lower and paper price pulls physical sentiment downward. Banks have coordinated metals suppression operations through multiple geopolitical crises over the past 2 decades. The resistance case is real. It is documented. It deserves its place in any honest analysis. But here is what the resistance case has to overcome. Iran has officially stated no red lines remain. Every target is theoretically available. Senior officials confirmed operations will continue for multiple days. Iran launched ballistic missiles at a U.S. carrier strike group, something not attempted against a U.S. naval vessel since the USS Stark incident in May 1987, and that was an Iraqi aircraft, not a deliberate state-sanctioned IRGC launch at American forces. The distinction in escalation calculus is enormous. Iran simultaneously struck U.S. military installations across 5 countries. Israel has declared regime change an explicit operational objective, not a byproduct, the stated goal. The Houthis have simultaneously resumed full Red Sea attack operations, activating a second maritime choke point concurrently with Hormuz. 2 choke points simultaneously, both in disruption. When both combatants have declared maximum objectives and neither is operating with enforced red lines, de-escalation requires a catalyst that does not currently exist in the data. Here is the layer that predates all of this and survives after it, whatever outcome this conflict produces. Silver has closed green for 10 consecutive months. Gold has posted its 7th consecutive all-time high. Silver lease rates, the institutional cost of borrowing physical metal in the professional lending market, were already elevated and climbing for 6 consecutive trading sessions before this weekend began. Spiking lease rates are not a futures market signal. They are an institutional physical supply tightness signal. The professional market was already pricing scarcity before any drone launched. Industrial demand has not paused. Photovoltaic manufacturing, electric vehicle battery systems, AI data center infrastructure, 5G network build-out, defense electronics, advanced nuclear reactor components, all require silver. All are accelerating. Global mine supply cannot match the acceleration rate. The structural deficit existed before Sunday morning. When Western markets open, here's the data that will tell you immediately what informed capital decided. Watch the gap magnitude on gold and silver futures at the opening bell. Watch whether Shanghai's silver premium expands past the 27-hour level or compresses toward paper. Watch whether Iran's stated operational timeline of multiple days holds or whether back-channel pressure produces a pause. Watch whether Hormuz tanker anchoring expands or begins to reverse. Watch how oil holds or surrenders weekend gains. The gap confirms or denies what physical markets already priced. Precision on what these weekend numbers represent. IG weekend spot silver near $100, Kinesis silver at $100, Hyperliquid at $96, PAX G gold at $5,400. These are not speculative retail trades on sentiment. These are physically backed instruments. PAX G is redeemable for allocated vault gold. Kinesis silver is backed by vaulted physical metal, trading in continuous real time while COMEX futures sit closed. When physically backed instruments trade $27 above Friday's silver settlement and $120 above Friday's gold settlement, the arbitrage mechanics are now active. Professional arbitrage desks require convergence at the opening bell, or the spread becomes mechanically exploitable within microseconds. The convergence pressure is structural, not emotional. It is enforced by the mathematics of simultaneous markets. Physical buyers in Shenzhen paying $120 and declining to sell back into Western paper pricing aren't reacting to headlines. They are applying local, first-hand market intelligence about where physical supply actually is and where it isn't. 3 assets matter in this environment: gold, monetary reset hedge; silver, industrial shortage play running a structural deficit that war didn't create and peace won't eliminate; oil, energy cannot be manufactured by central bank policy. The Strait of Hormuz is functionally frozen, not by blockade, by insurance pricing and 150 anchored tankers. The structural metals deficit was already breaking the system before the first missile left its launcher. Follow on X for real-time updates as futures open. Significant data drops. Another video comes fast. Invest with intelligence, not with urgency. This content is for educational and informational purposes only. Nothing in this video constitutes financial advice. Precious metals markets are volatile. Always conduct your own due diligence before making any investment decisions.